To start off, the title here was somewhat controversial. Mohan chose the most controversial suggestion I offered. What's wrong with angel investors and accelerators usually is based on what we've kind of been making screw-ups, I guess, over the last 5 or 10 years. So most of this is really about our experiences, not always just other people. I guess just briefly, some background. 500 startups, we're about 110 million under management. 30 people across 6 countries.
Can somebody hit the next slide?
Okay. Yo.
Yeah.
We have about 30 people on the team across 6 countries. About 12 of those people make investments. In the last 4 years, we've invested in over 700 companies, and about 25% of those have been outside the US in about 40 different countries. And Kylie leads our investments here in Southeast Asia. So if you're in the audience and looking for money in Southeast Asia, don't hit me up, hit him up. And he's the person writing checks. So just some background, I guess. I've been investing probably for about 10 years now. I started doing angel investing when I was in PayPal in 2003-04. As I was leaving. And for at least the first 5 years, I wasn't really paying too much attention to what I was doing in angel investment. But, you know, I'd made about 13 investments over a period of 4 years between 2004 and 2008. Of those 13 investments, 3 did reasonably well. Mint.com was acquired by Intuit, about 120 million, I think. SlideShare by LinkedIn for a similar amount, and Mashery for I guess about 180 to 200 million by Intel. Now those were 3 decent-sized wins. Those are about 10 to 20x returns. Most of my checks were relatively small. They were around $25,000 or less. But the other 10 investments didn't work so well. So the majority of my investments failed, or at least did not return substantial amounts of capital. And that's a similar story, I think, with accelerators and venture capitalists as well. So probably lesson number 1 is don't assume you're too damn smart, and even 1 out of 3 investments working is actually probably pretty darn good odds. Okay, so before I get into that, the number 1 rule for angel investors: don't turn down Uber at a $10 million valuation because you think the price is too high and you're worried that Travis is not running the company. I did that. Yes, that was a big mistake. But I think the main thing I would emphasize with angel investing is to have a portfolio approach. There's certainly folks who have a very concentrated approach in investing in companies, but obviously with a name like 500 Startups, our theory is that most things fail, and that probably as an angel investor, having a portfolio of a minimum of 10 to 20 investments is really critical to have some shot at success. For a lot of angel investors, they come from more traditional industries, real estate in particular, where most investments do appreciate, but they appreciate slowly. So in real estate, probably most things you invest in don't lose value, but they also don't appreciate in value dramatically, although certainly in some markets that does occur as well. So when real estate investors tend to get into the startup world, they tend to think that everything is going to be Facebook or Instagram, and a little bit too much concentration in 1 or 2 really great investment stories. Whereas the reality is that most things fail and a few things succeed asymmetrically. In order to take advantage of that, you probably need a larger portfolio size. I'm going to hand over to Kylie for a little bit to talk about his background and experience.
Yeah, well, before I joined 500 Startups, I primarily built 2 companies out of Malaysia. So my experiences raising money from angels and raising money from VCs are born from this region. So the 2 companies I built, one was an e-commerce company I sold to Groupon. Another was a social news site I sold to Catch-Up Group. And after I did those 2 startups, I did a lot of angel investing of my own. I invested in 3 companies in this region and 4 companies in the US. I got quite addicted to it. So I decided to do that at scale, and working with 500 Startups allows me to do that. In that process, I've also kind of mentored at accelerators a lot, including 500 Startups' very own accelerators, and also accelerators in this region. And putting together a lot of those direct experiences, like I've come to see a few things which are very relevant for angel investors in this region as well. So like Dave mentioned, a couple of do's for angel investors to get really smart about creating a portfolio and such. I think for in Southeast Asia, there's less of it now, but I remember there being quite a lot of predatory angel investors as well. Some who would oversell their value add. I mean, it's true that a lot of angel investors here have who get involved in it may have a lot of business connections, a lot of direct skill sets to add to a startup. But if you overvalue those things and you take too much capital out of the startup in the first place, it can be very damaging for them to be able to raise follow-on capital. To give you one true example, one startup who was quite popular a few years ago, right here at Echelon on stage, everyone's quite excited about it. So I went up to follow up on the deal. I found out that on the angel investors took 85% of that company. So the founder had 15%, and it was a great company, great founder. And the story was that his angel investors coined themselves as business partners, promised a whole series of value adds which weren't delivered. But the cap table has already been executed in that fashion, and his kind of like, oh, I still want to run, I still want to grow the business, how do I restructure this? It's tough. It's very, very tough. So I don't think that case happens too much here in Southeast Asia these days. I think a lot of founders read enough TechCrunch and Quora, to have some line of defense against such a suggestion. But at the same time, like if a lot of you are doing angel investing now, and a lot of you are considering angel investing, thinking about how many percent of the startup you want to take, and figuring out how many stage that out to how many percent you want to dilute later in the next raise, I think is an important thing to think about. Unless, of course, you intend to put in all the capital for the whole lifetime of the startup, which is another...
85% of a small company is effectively zero. So optimizing for a large ownership when the company is still small is not a long-term success story, and really very discouraging to later stage investors. If we see companies that have given away a large percentage of equity to the angel investors, that's really discouraging for us to put more money in. We have a significant concern about whether the founders are going to be motivated to continue growing that company to a large degree.
And I think for a big part as well, in the dynamics of negotiation between to invest in a startup as an angel investor, sometimes like the seduction to sell your value proposition to a startup may see you trying to demonstrate your value, like kind of acting or at least demonstrating that you can add a lot of value to that startup. And in my experience, like I've met some potential investors who would spend the first half an hour telling me everything that's wrong with my company. Like I would say, oh, right, I'm working on this for this. And they're like, oh, have you thought about that? Oh, how about this? How are you going to solve that? So the first 30 minutes start off as some kind of like combative defense attack. It feels hostile. And I can see the first half an hour go through that and it says, oh yeah, you got a lot of problems. I see a lot of problems in your startup, but I can help. Right? And that's where kind of the sales pitch kind of begins. So going through some of those experiences is very refreshing when you come across an angel investor who asks a lot of questions, listens very intently about what's going on, and connects the dots to see potential that even you as a founder don't see. Very refreshing. And when you come across an angel investor like that, like you want to take the person's money because you're excited to spend more time with an angel investor because you're getting so much value out of it. So what I would recommend for a lot of angel investors is, even though some of the ideas that come to you or some of the founders come to you may have kind of a lot of gaping holes in them, the first meeting to construct excitement around the startup's idea, to connect the dots and add more value, to demonstrate a lot of value in a real sense to them in the first meeting, I think is critical to starting off a good relationship with them.
I think for both angel investors and for accelerators, one of the initial exercises that you probably need to go through is identifying how you are going to present yourself to the entrepreneurial community. And really, it's very similar to, as a founder, doing competitive differentiation analysis and trying to figure out what part of the ecosystem you're going to serve. So as an angel investor, that may be whether you're going to focus on a specific discipline area. Could be engineering, could be recruiting, could be marketing. It's also probably choosing a stage or a vertical. So whether you're going to be starting out in very early stage investing, Series A or later stage investing. Possibly could be an industry vertical within a geographic region or within a type of business. So consumer commerce or B2B, SaaS businesses, education topics. So it's hard to be great at everything, and so being good or notable at probably just one thing is more important than trying to be decent at a lot of things. So that brand differentiation and where you're going to value add and what you're going to kind of like present yourself to people, it's probably good to be very specific and niche focused within one of those kind of stage, category, vertical, whatever you're offering people. And that's not necessarily different for accelerators versus angels. Particularly for accelerators these days, I think there's too many people trying to be everything. And so specialization within accelerators based on one of those stages, verticals, or industry categories is helpful.
One example of that is there's an angel investor in Malaysia. His name is Tan Swee Yong. In 2005, he listed a mobile-related company, and then it got acquired after it went public. And so he spent a lot of time investing in more mobile companies in the region. And his track record is amazing. He's a quiet guy. Not too many people know about him. But the founders who do stuff related to mobile and apps, they seek him out. They know that he's adding a lot of value as far as mobile is concerned. So for a lot of you who are, to Dave's point, like a lot of you who are angel investing, I personally seek out angels who are specialized at a certain area so I can kind of assemble around to co-invest into companies. So if any of you are specialists in any certain area, I'd love to connect to co-invest in a lot more deals as well. But I think building a specialty, especially in Southeast Asia, and having a lot of those kind of specialty angel investors is going to be a real value add.
One of the things that was challenging for me getting started was learning about all the different types of legal structure, financial valuations, and due diligence as I was getting started. I had a background as both an engineer and a marketing person, so I kind of felt I had a decent understanding of whether companies and products were good, but I did not know much about the rest of that. As a way to hack that, what I did was basically co-invest with other well-known and experienced investors. So I got the really lucky in that I got to co-invest with Ron Conway, Josh Koppelman at First Round Capital, and several other early folks at PayPal. What I found with that was as a small and early stage investor, I had very limited ability to change legal structure or valuation. So for the most part, doing a lot of due diligence on those parts of the topics or kind of trying to figure out ways to negotiate on legal was relatively difficult for me. So as a way to just get started with that, I co-invested with other people who had more experience, had more ability to negotiate, and was basically using them as a way to kind of get to reasonable sort of documentation, reasonable valuations, and reasonable portfolio selection.
I guess kind of wrapping up a little bit on focusing on angel investments, do's and don'ts. What I also find is that if you're an angel investor of a lot of value to add, sometimes the founder may offer kind of there comes a point where sometimes you need not to take advantage of a founder who really wants you to invest. So I'll give you a personal story. My first angel investment, personal one before 500, was in a company called iMoney. So when I met with the founders and chatted about the idea, they suggested that the lead founder take only 30% of the company and the other co-founder take another 20% of the company. But what I told them was that the lead founder is spending most of his time, he quit his job, he's spending all of his time on it, he needs to take the majority of this company. And I kind of put my foot down. And I had the other co-founder kind of recognize that. That decision went down very well because over time the company grew. They raised a seed round, 500 grand. They continued to raise a Series A from a set of global investors, 2 million. And now they've got term sheets for Series B. And all that happened under 2 years. And eventually the second co-founder who was part-time eventually joined full-time as well. And the decision to ensure that the founder who was working on it full-time had a majority of the company and was adequately incentivized, I think that was a really good win. So for a lot of you angel investors out there who are people considering angel investors, even at conferences like this, you're going to meet a lot of great founders and you can see a lot of great opportunities to invest. So do enjoy yourselves and don't be a dick.
That last part is actually quite important. Yes, you can clap for don't be a dick. That is an important thing.
It's like the key takeaway.
one other last item. I think there's a lot of time that investors spend thinking about due diligence, and other investors tend to talk to each other about, oh, make sure you're covering all the grounds. And I would, yes, doing due diligence and understanding who you're going to be investing in and what the structure of the company is really important, but let's take the larger perspective, which is very few things kind of work, and trying to identify what's going to be a winning strategy or company is probably a lot more important than whether someone has, maybe, failed a course in college or occasionally had, some scrapes with the law. This is kind of strange, but we recently invested in a company where we did background checks on the company, and turns out that one of the team members had a DUI. One of them was in some jail time for substances which I won't discuss in Singapore. One of them had several name changes. We decided to invest in the company anyway. And the reason that we kind of made that decision was that, definitely there's going to be non-linear events in the lives of many entrepreneurs, particularly many young entrepreneurs. For those of you who have been young at one time, we make a lot of dumb decisions early in our career. But we were really excited about the product and the opportunity that company represented. So a lot of times, angel investors will take a really long time to go through saying no or yes to a company, and I would say that's pretty much death. Like, if I were an entrepreneur, I would really hate to work with people who take a long time to make decisions. And even a quick no is better in many cases than a long yes. So a lot of those due diligence decisions, yes, you should try and work through whether these things matter to you, but ultimately you're trying to find outsized wins. And whether a company fails quickly or slowly or has a small sort of story is not as important as being able to find good and larger stories. So try and make decisions quickly and optimize for the long run. Let's switch over to the accelerator topic.
Yeah, let's do that.
So 500 Startups has been running an accelerator program now for about 3.5 years. We've had 10 batches that we've worked on through 500 Startups, actually another 4 with our Latin American office. And I had previously ran the Facebook Fund incubator program in 2009. So not that that's a lot of experience, but say around 4 to 5 years of experience, probably about 12 or 13 cohorts and roughly 250 to 300 companies. Y Combinator and Techstars are probably the other 2 large programs that have had long histories in running accelerator programs, but the entire industry itself is really not much more than 10 years old. And so a lot of best practices in accelerators are still emerging. Again, similar with angel investment, I think figuring out what your brand and thesis is going to be all about and what type of stage you're going to focus on. So whether that's a B2B set of companies, whether it's a particular industry, what type of stage you're going after. The primary thing I will say, though, is really twofold. One is helping companies raise downstream capital. It's pretty much one of the most essential elements of an accelerator, and if you're not, as an accelerator manager, thinking about how you can help arrange the round of funding that's going to come after demo day or as those companies are getting out the door, you're really doing a disservice to all of those companies. That doesn't mean that you have to get all of them funded, but probably if you're not aiming for at least a third of your companies to get some reasonable amount of critical mass of funding, i.e. 6 months of runway or more after they leave the accelerator, then you're probably not going to be successful at running that accelerator and not going to attract future talent.
There's also a slew of new accelerators in the region. Some of them are actually started by corporates. For a lot of the founders who are applying to accelerators and considering accelerators in different parts of this region, I think one thing to watch out for, and this applies to accelerator managers as well, is the whether or not they've got a fixed curriculum or not, and where that suits you. I find that especially of new accelerators, sometimes they've got a very fixed curriculum to go about things, and that may work very well in some cases. For a lot of cases, it actually doesn't work that well. They would, I'm not going to name names, right? But but there's an incubator that I was kind of giving some advice to, where they had followed a very strict curriculum, and they were trying to force fit founders in the accelerator to attend these classes, and they had to attend a minimum amount of these classes. And they quickly learned out of the first batch that that was not good for them, and it wasn't good for the founders, and that was not cool. So that's something I think to watch out for as far as curriculum is concerned. I don't know about for us. Like, do you think that our accelerators are too loose without curriculum, or
Well,
where do you think we stand?
I think initially we had tried to schedule as many amazing mentors and speakers and topics as we could possibly cram into a 3 to 4 month period. And what we found out was that actually the companies that were most successful sometimes were the ones that least attended the curriculum that we were putting together. And you know, I think that you need to be cognizant of, like, accelerators are not quite the same as universities, and that we're not trying to reward best attendance in class, and grades are not really the outcome. So the outcomes are, do companies have products that are interesting? Do customers use and pay for those products? And does funding happen? Like, those are the KPIs and metrics that are actually useful for those companies. So whether they come to our, you know, speaker topics or not, and whether they, you know, sort of follow all of our directions, we're actually okay with a lot of our companies ignoring our desires for, like, the topics and curriculum that we put together. We try and be helpful, but, you know, ultimately, whether you attend our accelerator classes or not, you have to run a company. And so figuring out what the KPIs for the company are, we try and do that within the first 2 weeks. We try and set a framework for metrics for the company within the first 2 weeks that they come in, and we try and understand, like, what the objectives are for those companies over the next 3 to 6 months. Then we really let the companies themselves pick and choose which of the topics they want to attend, whether there's certain mentors that are helpful for them in the environment. So we're always trying to be facilitative, and we're always trying to be helpful, but at the same time, we don't want to distract the companies too much from the fact that they are trying to solve a very complex and hard problem and try and get customers and raise capital. So ultimately, when we're thinking about it, really it's users, revenue, which equals customers, and capital, which are the 3 things that we're trying to identify and help them get done.
And part of, I think when I first joined as a entrepreneur in residence in batch 5 in the Mountain View Accelerator, what I quickly found working with 33 companies at the time, of which 70% of them were from outside of the US, was a lot of them felt overwhelmed by the kind of pressures they had to produce X amount of traction during demo day, pressures from their peers because they'll be joining a cohort with other founders. So all kinds of personal pressures, and at the same time, you've got mentors being brought in, giving them all kinds of advice. Some asking them to walk north, some asking them to walk south, and there's, oh my God, so much conflicting advice. I think it's quite a tough experience being in an accelerator, or even being without one. So what I would say is, for anyone running Accelerator or joining Accelerator, encouraging a kind of inner compass for each of the companies is so critical. It's like I have a very strong filter. Most accelerators will bring in all different types of mentors and chuck in as many mentors as they can, and give all kinds of advice in the best intentions to help you. But without that strong inner compass, it is really difficult to navigate that and come out of the accelerator with a clear direction and clear progress that you can show off.
And I think one thing that we've also found is that the companies that tend to be most successful are the ones that aren't usually the best students. And actually, we try not to be educators who always know the answer. In fact, we're almost intentionally trying to get them to not listen to us. I know that sounds weird, but, like, people who are good students aren't always usually good entrepreneurs. This is actually something that I try and emphasize when I'm in Singapore particularly, because I think there's a lot of rule following and a lot of structures created to help entrepreneurs, which I think also encourage that rule following. And I've said this before and probably pissed off some people at Singapore, is that you should not be more focused on getting money from the government programs that help you start the business than you should be at getting customers. So getting customers is the most, well, don't clap too much because people in the audience might see you and then they might not give you some money. You do want their money, so I hope I'm not pissing them off too much. But the thing that I want to emphasize is, like, you know, as a person running an accelerator, don't act like you know all the answers, because you don't. And, like, identify the entrepreneurs who are not always listening to you, because they probably know something a little bit better. You want them to have a little bit of an edge. You want them to intentionally, you know, not listen to your authority, and you want them to find their own sort of inner compass, as Kylie was suggesting. And in fact, what you're really trying to do is, rather than teach them how to be an entrepreneur, how to be successful, is you want to facilitate an environment for them to discover success, right? Which is sometimes about throwing a lot of chaos into the same world and creating this environment that's really around urgency and problem solving, but not because you're guiding it. So you basically want this very active petri dish that's got a lot of different things fighting around in it that aren't necessarily listening to you, and it seems like super chaotic, and you're like, holy crap, like, how is anybody figuring anything out in this environment? But like that environment like is what's going to toughen those people up and actually help them figure out how to succeed. So the companies that tend to survive and succeed are usually the rebels in the environment, not the ones who are listening to you. And in fact, if people start listening to you too much in the accelerator, those are probably the ones that you want to fire and get out of the mix. Sounds very non-intuitive, but that's how we think about it.
I think this problem, Dave, is like especially, I see it especially, I wouldn't call it a problem in all cases, but this phenomena is especially apparent in Southeast Asia with a lot of the accelerators and incubators that I spend time with. Mostly because growing up in Southeast Asia myself, like I've kind of seen a conditioning where you have a respect for authority. And when somebody's called a mentor, like you're a mentee or you're a student, you automatically, a lot of the people of authority is on some kind of a pedestal. And like you're seeking them, oh please, wise man on hill, give me the answer.
Give me all the answers to my startup
woes, right? And that's a lot of times they don't know any better than you. They're trying to figure stuff out, and because they have a position or a title as mentor, they may brainstorm about answers in a confident manner. But a lot of times they don't know any better than you. So what I found in batch 5 was that a lot of the founders there are so much smarter than I am, and have these. They're brilliant and they're solving such inspiring problems. What I find as a power tool of sorts for angel investors working with founders, as well as anyone involved in managing accelerators, is the power of a facilitative discussion. You're going into the discussion saying, okay, so what do you want to talk about? What are you losing sleep over? What keeps you awake at night? What are your top 3 challenges? And you're just asking a series of questions. The founder goes on and talk. I take a pen. I draw what exactly they're saying. I try to make sense of what they're saying. Oh, so you're thinking about these 2 things, but they're in conflict. How's that? How's this? At the end of half an hour, I have not given them any new input at all. And they're like, and they're taking pictures of what I drew on the wall. Like, wow, Kylie, that's genius. I'm like, exactly, right? And I walk out. I've not given any new input. Like, Rob, you're laughing over there because this is what I do with you, man. This is one of portfolio companies. We sit down, we have lunch. He's doing all the talking. I'm just doing all the drawing. And then he looks at that. He's taking pictures of this. Like, oh, this is my map for the next 3 months. Right? But it's all him, man. Or Rob, it's all you, bro. So the power of a facilitative discussion, going into a room, assuming you know nothing, assuming the founders know much more than you, and your job is to get that knowledge clear.
Last thing I would say is I think making sure companies don't run out of cash is a continuing exercise that's really important, whether you're talking about an accelerator or an angel. It's not always possible. Again, most things are going to fail. So yes, a lot of companies are going to run out of cash and they're not going to be successful. But try and emphasize to entrepreneurs that they should not be trying to figure out and solving fundraising problems when they have 1 month of cash left. That's not going to be a very easy time. So kind of keeping companies with 3 to 6 month cash reserves kind of as targets and getting them to be urgent about figuring out how to resolve that either through customers or through financing if they're getting down to those levels. One last item about accelerators is I think you want to put the accelerator physically in a location where serendipity is possible. Sometimes we see a lot of accelerators placed in corporate business parks or places that are very cheap for rent. And that's not always ideal. Obviously, you don't want to be paying, huge rents and like a lot of upscale environments, but you want to be in an environment where people are going to drop by for serendipity. That could be investors, it could be other entrepreneurs, it could be mentors or partners, but you want to kind of be in the flow of activity and in a place where both the founders and other employees, other partners of that ecosystem want to arrive. So kind of a balance between the cost you're going to pay for setting that up and the serendipity that you're putting yourself into.
It seems like Block 71 was at the right place. I heard Dave just waltzed into Block 71 yesterday and there were no staff around. So you just hung out with some startups and then you walked
Very
off.
serendipitous, yeah.
Well, big shout out to JFDI. We've invested in a lot of their companies. I think the folks there, Ming and gang, like run a really good program. True in Cube in Thailand, they run a really good program as well. We've invested in some of their companies. Personally, I'd love to see more accelerators get set up so we can invest in more of their companies, and also to spend time with the accelerator companies before or during. I love doing that. And I'd love to see more angel investors, or maybe angel investors from angel groups to invest as a group. And if you guys want to figure out how to get paperwork, how to get those entities, or even talk about how setting up an angel group in your country works, we'd be happy to have those conversations. Because angel investors and accelerators, you're the lead generation for the rest of the startup ecosystem. Without you guys, and if you guys do your job just 20-30% better, there'll be 20% more startups downstream who become big exits and big success stories. And this whole virtuous cycle just gets accelerated because you guys decided to do a better job. We've, as mentioned, we've screwed up a lot in our journey of doing a lot of these things, right? So if any of the things that we've done wrong could be useful to you, we'd love to have those conversations and hopefully generate new ideas, new ways to get this done much better.
One other last item, big fans of AngelList. We're investors, so we're slightly biased, but I would strongly encourage, if you're doing a startup, put your profile personally and for your startup up on AngelList, or multiple startups if you're working on multiple ideas. And as angel investors or accelerators, use AngelList to both identify what you're investing in and build a funnel for the companies that you want to fund.
Well, I guess that's it.
That's about it.
Yeah, that's just right. Thanks, everyone.